في محاضرة جدا جدا قيمة برعاية شركة افكس برو لمستر أنتيباس عصفور. رح تكون باللغة الإنجليزية بس في ترانزليشن، في رح يكون ترجمة طبعا للي بده، يعني للي مهتم. يعطيكم ألف عافية. ألف عافية.
My name is Antypas Asfor, and I'm responsible for managing client funds, part of the portfolio management department at FX Pro. The past year has given rise to significant FX volatility. Large number of events occurred which shaped the forex markets. We've seen significant US dollar appreciation over the past year on the back of an end to the Fed's asset buying program. Recently we saw the European Central Bank implement its own quantitative easing program. We had back in December the ruble crashing. We had the Scottish referendum and the UK elections more recently that impacted the pound. And even though all these events are rather significant, were rather significant in the FX markets, probably the most significant event, and one that will be recalled for decades to come, was the removal of the Euro CHF floor and the events that took place as a result. What I intend to elaborate over the next 30 minutes or so is what happened during the CHF event back in the 15th of January, why it happened, and what lessons we can learn from this going forward. Before we begin though, please take a note of the disclaimer. What it essentially says is that what I'll be covering today should not be seen as investment advice, so I'm not advising you to buy or sell any particular currency or any other instrument. Okay, so let's get started. The aim is to decipher the CHF moves by examining why did the Swiss National Bank place a floor on the Euro Swissy. Why did the bank remove the floor? What were the consequences of the removal of the Euro CHF floor? And what lessons can be learned from the CHF event for future reference? So that we're all on the same page, it pays off to explain what a currency floor is. A currency floor is the lowest price at which one currency can be exchanged for another. Now, in our case, the 120 Euro CHF floor, which was instituted by the Swiss National Bank in 2011, meant that 1 euro could not buy less than 1.20 Swiss francs. Some of you seem to be wondering, why did the Swiss National Bank implement the floor? Well, the main reason was that the Swiss franc was overvalued on the back of an economic slowdown in the Eurozone. Back in 2011, we had the sovereign crisis in the peripheries in the Eurozone. So what were known back then as the pigs, Portugal, Ireland, Greece, and Spain, where their bond yields reached record levels. And there was significant fear in the markets that Greece may default, which hasn't changed much over the past 4 years. But back then it was more of a general fear in the whole of the Eurozone that the crisis was not over. The crisis that began in 2008 was not over, and it has given rise to a sovereign crisis. So as a result, the Swiss franc was appreciating because it was seen as a safe haven, and that appreciation reduced the competitiveness of Swiss exports. So that threatened the economy of Switzerland. So the Swiss National Bank decided to intervene by placing this floor in order to help its exports, and as a consequence help its economy grow and prevent further deflationary risks arising. But how did the SNB place this floor? Well, it started with a statement and a lot of euro buying and Swiss franc selling. And this is the statement that was issued. I don't know how, whether you can read it from where you're sitting, but the important bit is the one in the middle, where it says, with immediate effect, from the second sentence onwards, with immediate effect, the Swiss National Bank will no longer tolerate a Euro CHF exchange rate below the minimum rate of 120. And the SNB will enforce this minimum rate with the utmost determination and is prepared to buy foreign currency in unlimited quantities. Well, it doesn't get much more explicit than that. When a central bank goes out with a bank, in this case, with such a statement, it's pretty obvious what they intend to do. And even though the markets may doubt their ability to do so, they did show very strong perseverance in maintaining that 120. Now here we see the sustained CHF strengthening. So the move downwards means that the Swiss franc was appreciating, was becoming stronger versus the euro. So we can see that from 2007, which is when the chart starts, the Swiss franc gradually growing stronger. You can see a big spike downwards in 2008. That was during the time of the financial crisis. In any crisis, there's a run to havens, to assets which preserve their value, which are not deemed risky. In this case, as is always, basically, the Swiss franc is seen as such an asset, similar to gold or similar to the Japanese yen. So we saw a Swiss franc appreciating and thereafter continuing to appreciate, moving on in 2010 and 2011 as the EU sovereign crisis was unfolding. And this led to some point the Euro CHF to almost reach parity, to almost reach a value of 1. And that placed a significant burden on the exporting of Swiss companies, because that meant that the other countries and the consumers of other countries had to buy their products, their exports, much more expensive for them. So that would reduce the demand and would reduce their international competitiveness. So the Swiss National Bank intervened in order to help its economy. The result of the intervention and the placing of a minimum value, of a floor of 120, was that price could not move lower than that level. They said that the Swiss National Bank said that they'll buy euros and sell Swiss francs in this case in unlimited quantities in order to preserve that level. So you can see that flat line in 2012. It's basically 120. There was no movement beyond that level. And at some point, the euro started appreciating. The euro economy started doing better. But then again, things started to problems started to emerge. And in this case, it was the deflationary risks of the Eurozone and the talks of an asset buying program implemented by the European Central Bank. So we saw a move back to 120, which is right there on the right side. And that's when the fun begins. The Swiss National Bank saw that it was unsustainable to keep buying euros and other currencies in order to maintain this floor level. So about a week before the European Central Bank implemented its quantitative easing program, its fully fledged quantitative easing program, they removed the floor. And the result was that spike in the markets. Okay, the CHF gained in excess of 30% as a result. And this move impacted trillions of dollars worth of funds around the world, because it had consequences across different asset classes. Now you're seeing the Euro CHF chart. The movements were not restrained or constrained to Euro CHF. This is the dollar CHF, where we were seeing the dollar appreciating in the latter half of 2014. And then we see this crash again in this chart in January of 2015. And the reason why other currencies were impacted, other CHF crosses were impacted, was because even though the floor by the Swiss National Bank was set at 120 versus the euro, the Swiss National Bank was diversifying its portfolio of currencies by selling those euros and buying other currencies at that time. So the impact of the removal of the floor meant that they had to sell those currencies, and the result was impacts across different crosses. Now we previously saw why the SNB placed its Euro CHF floor, but let's now see why they removed it. Main reason was that it was an unsustainable policy, especially as the European Central Bank was set to implement its quantitative easing program, buying billions of assets in order to boost its economy, and this would lead the euro lower, and that would mean that the Swiss National Bank would have to do a lot more buying as a consequence, and that would lead to a very big war, currency war, between these two central banks. And the European Central Bank, being larger, would probably win the war, so the SNB decided to step back. There was also less of a need to maintain the floor because the US dollar had appreciated, so we saw dollar CHF moving higher. So the Swiss exports were still competitive, even though the main trading partner of Switzerland is the Eurozone. And there was also less need of havens as a result of the dollar appreciating. Another issue was the ballooned balance sheet with almost $500 billion francs of foreign currencies held by the bank. Place this in perspective, the balance sheet of the central bank was 75% of Switzerland's whole GDP. And you may be wondering, okay, how does this compare to other banks, other central banks? Well, here we've got major central banks and their assets as a percentage of GDP. We can see that generally they're around 20% for the European Central Bank, Bank of England, and the US Fed. Bank of Japan, which has been intervening for years, has a very large balance sheet, but even that is much smaller relative to the balance sheet of the Swiss National Bank. And Bank of Canada is a bit of an outlier in this example. In this chart, it's around 5% bank assets as a percentage of GDP. Now, could this floor removal have been predicted? Well, there was some writing on the wall. I mean, the ECB was expected to announce a fully fledged asset buying program, and most economists were expecting that this would take place the week following the CHF spike. And as we said, the SNB would likely be a loser in such a currency war. So the fact that the ECB was going to loosen its monetary policy further, it had decreased interest rates a few months before that, so it had already loosened its policy. And the fact that it would loosen it further meant that there would be a much greater strain for the Swiss National Bank, and especially even more so by the fact that the exchange rate between the euro and the CHF was exactly 120. It was 120.10. It was right on the floor. So that meant that would have to implement aggressive euro purchasing at the time when the European Central Bank was loosening its policy. Now, this is one way of seeing things. The other way was just 3 days before the Swiss National Bank removed its floor. Okay, removed its floor on January 15. So on January 12, just 3 days prior to that, the vice president of the Swiss National Bank, Jean-Pierre Dantin, mentioned that the bank is convinced that the minimum exchange rate must remain and it must be the cornerstone of their monetary policy. So just 3 days before the removal, the bankers were out there and saying that we'll stick to our plan and stick to this floor we have placed. The thing though is that even though maybe we couldn't have predicted the removal of the SNB floor, it would most likely end up being a messy environment in the markets. The decision was a surprise in the markets, and as the SNB president mentioned, there was no other way it could happen. And the chart below, the picture below shows the movement that took place on Euro CHF the day the floor was removed. So for those of you who are a bit better in looking from a distance, may notice that a couple of trades there were opened at 11:30 and 49 seconds, a bit below 120. So these were shorting trades, and within 3 minutes, less than 3 minutes, the exchange rate was parity. So the first trade closed at parity, at the level of 1. So it took just 3 minutes for a 2,000 pip move. So the markets were at havoc at that time. But what triggered these rapid moves? Well, one thing is the algorithms that are being used, high-frequency trading algorithms, by a number of investment firms. As soon as the 120 was broken, or a few pips below that, algorithms were triggering stop losses, so they were sending orders in order to close their trades. Moreover, an extreme number of traders were long Euro CHF. Because of this floor, they were saying, okay, the price can't move below 120. So they were seeing it as a one-way bet. Price can only move up. So they were constantly buying with an exposure of around 95% of traders being long the currency pair and only 5% being short. So this large number of long traders started receiving margin calls and stop outs because of the adverse move, especially since the move was so large and so rapid. Moreover, liquidity providers, the large investment banks that provide liquidity to investment firms, smaller investment firms, withdrew their liquidity. They weren't giving quotes, or they were giving absurd quotes. So at some point, the quote was 0.07 on the Euro Swissy, when it was 120 just a couple of minutes before that. So they were just giving absurd quotes because there's either a system failure or because they just didn't want to make the market. They didn't want to provide liquidity at that time. And additionally, we had a run to havens because of this spiked volatility, with risky assets taking big hits. The gold and yen soared that day. They moved significantly higher, but oil plummeted, and the Swiss stock exchange SMI took a major hit as a result of this move. And it was a move by the Swiss National Bank that didn't just impact the Swissy. It impacted funds that manage assets, as well as companies, investment companies around the world. So let's see some of the impacts that occurred as a result of the floor removal. Everest Capital's Global Fund, that's a macro hedge fund, closed after losing almost all of its $830 million in assets. So a major loss in just a single day. Comac, another macro fund, lost 8% on its CHF trading. Now that's a pretty big loss on a single bet. Harness Macro, which manages more than 750 million, lost 8.8% in January. Okay, these are hedge funds. They're supposed to generate significant return, but at the same time, you know, they generally try to limit their risk and their exposures. And the final example here is Fortress Investment Group, which lost 7.64% the week the floor was removed. Now, with regard to the retail FX markets, the news was even more devastating. So here we have some notable losses, publicly released losses by FX firms. First, without a particular figure, is Alpari UK. I don't know how many of you are familiar with this particular company. It was a major brand licensed by the FCA in the UK, and as a result of the CHF move, it was placed in administration because it wasn't sufficiently capitalized. A similar case was the smaller firm in New Zealand firm, XL Markets, which also became insolvent as a result of the CHF events. And we've got three other examples of public companies. IG lost $45 million in that particular day. Interactive Brokers, 120 million in losses. And FXCM, 225 million in losses, and was bailed out by Leucadia National with a 300 million loan. And its share price during those days lost 90%. So you can imagine the devastation the CHF event caused for that particular company. Now, how did FX Pro fare in this mess? Well, the firm did incur some losses, but FX Pro has emerged stronger. Just a couple of highlights here in February. The highest number of trades executed in a single day, and the highest volume traded ever in a single day was following the CHF event. Obviously not on the CHF event, but following the CHF event. And you know, whatever doesn't kill you makes you stronger. So the firms that are well capitalized and have a brand name for themselves can prevail in such opportunities. You know, in every crisis there's an opportunity. So it's this opportunity that the firm tapped on, and as a result, it saw a significant increase in client registrations, as well as in its trading volumes, just as to show you that it wasn't just a single day event, the numbers shown at the top. Now you may be wondering why FX Pro has fared so well. Well, for me, the contributing factors for FX Pro's growth during the industry's most turbulent times was that the firm abided by its negative balance protection following client losses. Now, what is negative balance protection for those of you who are not familiar? Negative balance protection means that if you incur any losses beyond your deposit, beyond what your equity is, the firm will cover those losses. So you can't lose more than what you have deposited. Now, some firms implement that, most firms don't, and even some that do implement it after the CHF event where they incurred significant losses, you know, they turned around and they found loopholes, and they try to salvage some of their losses from clients. Now, the firm has maintained this balance protection, and following the event, any clients that had losses in their accounts, these losses, negative balances, these negative balances were erased. Basically, their equity was moved to zero within a couple of days or so. Moreover, the firm reduced its spreads to the lowest spreads ever the firm has ever had, and it facilitated broker-to-broker transfers. Now, regardless of this success, there's still lessons to learn, not just for FX Pro, but for every FX company, for regulators, and more importantly, for all of us who trade. With regard to currency pegs, it's important to note that and to acknowledge that the currency pegs are placed for economic purposes. And once they cease fulfilling their usefulness or they become unsustainable, as was the case with the SMBs, they are scrapped. And this may give rise to a shock in the markets. Also, we learned that the credibility of central banks can be questioned. We had the Swiss National Bank just 3 days before removal of the floor reiterating and stating that they will preserve that floor and that they consider it very significant for their monetary policy. So if a well-developed central bank cannot be trusted to some extent, then this gives rise to the question, which central bank can be trusted for its rhetoric. Additional lessons, maybe even more important lessons, are there for FX companies and regulators. Better risk management policies and exposure monitoring systems need to be implemented by investment firms, by FX companies. And regulators and FX firms should be conducting stress tests and sensitivity analyses. They should be saying, okay, what will happen if the CHF removes its floor? What will happen if a tsunami occurs or if some other disastrous event that may impact the markets? And they need to be prepared and see whether their systems and their capitalization can maintain afloat in case of such an event. There should also be limits on leveraging in order to reduce one-sided exposures. If you have all of your clients going one direction, then your exposures are significantly one-sided. There should also be more stringent suitability tests for client acquisition. The FX markets and investing overall is not for everyone. There should be more strict questionnaires and evidence submitted in order to assess whether or not that particular client can make use of that particular service being offered by the investment firm. And there should also be less deceptive advertising and dubious marketing practices which are employed by many FX firms in their attempt to get more clients. The ethics to some extent are put aside, but more importantly, the targeting of clients is not what it should be. You should be targeting clients who understand your product, not everyone, in an attempt to generate clients by numbers. And also clients from their side need to become more and better educated on trading and risk. And that isn't just the client's responsibility. The responsibility lies in the regulators and lies in the FX firms in order to implement policies and measures that will educate their clients in order to better understand what they're investing in. Now, with regards to traders, the key taking point is that there's no free lunch, okay? Any form of trading or investment entails risk. You had everyone trading on Euro CHF in the belief or the determination that there's no way that they'll lose money because price will not move below 120. Well, price did move below 120 and moved rather fast, and people lost a lot of money. So there's no free lunch. Wherever there's a return, there's some form of risk, and investors need to assess that risk. Moreover, what goes up can go down, so you need to assess alternative scenarios. The Swiss National Bank implemented a floor. The result of that floor was the Euro CHF moved significantly higher. When the floor will be removed, the most likely impact of that will be a move downwards. So even though you're convinced that price won't move lower than 120, you need to assess a scenario. What will happen if price does? How much do I risk losing? And stop losses can help in this case in order to limit the cost of bad trades. And also, a final taking point is that more leverage is not necessarily better. Over-leveraging can magnify the size and the speed of losses. Okay, you can lose a lot more faster if you leverage more than you do. So these are my main taking points. I'll be more than happy to answer any questions you may have from what we've covered. So any questions? Okay, so I guess that was pretty clear for everyone. Thank you all for your time, and enjoy the rest of the expo.